Welcome. Wow, did you see the news? It's been so crazy. Everybody's been talking about GameStop stock. Apparently, there's a group on Reddit called WallStreetBets. It's this subgroup that has 5 million readers as of January 28th, 2021, and they have been talking up a storm about investing in this retailer GameStop, and that has sent the price soaring. Wow, this is so huge. The media and major trading platforms are talking about the stock's volatility, but some who support the Redditors, they're saying things like, "This is a peasant revolt against the rich." But from what I've been hearing, I think that the whole situation is a bit misunderstood. The information in this presentation is factual and taken from publicly available sources. It is not advice. Any opinions expressed here are for the purpose of sharing a point of view for educational purposes. If anyone should act on any of this information, it is solely their own responsibility. Do your due diligence and research before making any investment of any kind, whatever that investment may be. Do not short stocks unless you are prepared to lose money. Do not buy stocks you do not understand. Full disclosure, I do own some stocks and ETFs. I have never bought or owned GameStop and do not intend to at this point. Please like, share, and subscribe and click the notification bell to stay up to date. I went to check my Robinhood account today to see what the stock price of GameStop is because I've heard what's been going on. Just out of curiosity, I wanted to see what all of the buzz was about, and I saw this message that GameStop and AMC could not be traded. I couldn't even check this publicly traded security on my brokerage account to get a price. This is insane. So, what happened? WallStreetBets is a subgroup on Reddit where users post ideas about investing, stock tips, and things of the sort. A bunch of the readers of this thread, they bought into GameStop because it's heavily shorted. Rumor has it that they wanted to buy into the stock to drive up the price of each of the shares so that they could make some money and that the hedge funds who bet against the stock would lose money. The subreddit group WallStreetBets has been talking about buying several stocks that were the most shorted stocks on the market. And as of January 27, 2021, the single most shorted stock on the market was GameStop. What is a short? A short is one of several types of stock options. You borrow a share that you want to sell, betting that the price will go down, and you make money when the price goes down. You lose money if the price goes up. Let's say I want to short one share of stock, call it XYZ, and that's currently trading at $10. This can't be done in real life because options trade in contracts of 100 shares each, and if you want to do short 500 shares, then you would buy 5 contracts. But to explain what this is, let's just say that we can short a single share of a stock and that the price is currently $10. Let's say I have $20 in my brokerage account, and let's also assume that the option is free, but in real life options cost money. That means that if I short at $10 and that the stock price goes to $3, I make $7. If it goes up $7 to $17, then I lose $7 on the trade and I have to buy the stock at a loss. If I start to short at $10 and the price goes up to $20 and I only have $20 in my account, then that would be subject to something called a margin call. A margin call is when my broker would say that I have to sell whatever I have for cash, that I have to have a liquid position to cover the $20 price of the share that I'm borrowing. And if that same stock would go up to $1,000 a share, then that means that the stock price goes to $1,000 a share and I get a margin call for that one share as well for an extra $990. There are investors who do make a lot of money doing shorts, such as Michael Burry of Scion Capital Management. He bet against the housing market in the United States in 2005, and he made a lot of money doing it. There are also a lot of investors who lose money doing shorts. For example, Bill Ackman of Pershing Square Capital lost an estimated $1 billion shorting Herbalife, and it nearly ruined him. Why short GameStop? If you have good reason to believe that the price of a security is overvalued and you're willing to take the risk, then I do not recommend this, but you can short the security. I have heard of people in the WallStreetBets group that are bullish for a number of reasons. For example, GameStop has a deal with Microsoft to expand their physical and digital game offerings. GameStop is a brick and mortar retailer, but they are expanding online, and they brought executives from Chewy an online e-commerce platform, onto their board. And some GameStop retail investors have also made comments that they actually like the business model, that you can get the game that you want then and there, you don't have to wait for shipping, and that you could even trade in games that you don't want, and you could trade that towards the purchase of a new game, or you could find games that you do want that are used and you don't have to pay the really high, fresh out of the box retail price. But not so fast. That sounds like good things only if you ignore the backdrop of the environment in which GameStop is operating. First, it is a brick and mortar store, and many of their locations are located in malls. Not only have malls been declining in popularity over the last few years, but public health concerns from 2020 have reduced foot traffic even further. This is affecting the larger and broader retail market as well. Second, and more specifically, their primary product is video games. Console-based video games such as Nintendo Switch or Xbox or PlayStation. Video games have never been more popular, but the medium of use has changed and sales of consoles and console-based games have been declining. As of now, most of the money from video games is made from online multiplayer interactive games that you play on your smartphone or computer or tablet, and a lot of them make money off of in-app purchases. So except for the hardcore gamers who require a high-powered specialized system, most would probably opt to play Candy Crush for free, and they make money off of in-app purchases and advertising. Third, and most specifically, is that GameStop has been performing terribly. I'll walk you through their filings I found on the SEC website and show you what I mean. We will look at their balance sheets and their income statements so that we could see what they've been earning over the last 9 months and the prior 5 years. When we look at their balance sheet, we'll look at their assets, meaning the things that they have, their liabilities, meaning the debt that they owe, and their equity, which is the dollar value of what the shareholders own in assets of the company. Their debt keeps increasing, and over the past 5 years, most of their assets have become debt. It's not an untenable position business-wise, but generally, if a company's debt keeps going up and their equity keeps going down, we would not normally consider that to be valuable or a good investment. Their debt-to-equity ratio, which is their liabilities divided by their equity, is 6.83. That's almost 7 times as much debt as the value of what the shareholders own. We can look at their income statement as well. On an annualized basis for the most recent quarter, they've been losing less money, but they still have annualized losses of over $75 million. As we can see over the past 3 years, they have been losing money, and this began before the effects of the 2020 retail apocalypse. On its home, without help from the outside, and without changing its business model, it looks like the company is and will continue to be in real trouble. So why would anybody decide to short this stock? They may have done their homework to determine that the company has been struggling and that they will continue to struggle in the future. They might have done their homework and they might be willing to take the risk. The investors who did not understand the risk of what they are buying had bought so much that it caused others to buy more. This then caused others to buy in, which then caused others to buy in, which drove the price up and got more to buy in. When the price goes up 10 times in 5 months, and then another 10 times in 5 days, the price action alone should be alarming. Driving up the price so that a wealthy investor loses money is not, in my opinion, justice against the wealthy. Many of the wealthy did not become wealthy simply by being greedy, but rather their wealth was earned, and for those who did not inherit it, they would have made smarter decisions to get there. That is similar to what happened in the 1600s in the Netherlands with regard to tulips. One thing that should not be forgotten is that we still talk about tulips 400 years after it happened, because it was so ridiculous that it became the clown meme of history when we talk about investing. I hope this was informative. Please be sure to check back in the future for more videos like this. Thank you for watching.